Good day everyone, my name is Wandani Jazmi. So, for our case summary, Palm Group Berhad managed 3,500 hectares of oil palm. At the end, 600 hectares contained in major FFB. Under pressure to impress a strategic investor, the CFO direct us to value these immature fruits at the full harvest market price of 150 ringgit per ton. This aggressively recognized a 6.5 million ringgit fair value gain in profit or loss using the excuse that market price exit under MFRS 141. To analyze this under MFRS, we must separate the tree from the fruit. The oil palm trees are bearer plants under MFRS 116 and must use the cost model because they are act as long-term production assets. Conversely, the growing FFB are biological assets under MFRS 141 measured at a fair value. This distinction matters because the CFO blankets valuations, ignores the biological risk, distort our true financial position and fails to achieve faithful representations for external investors.
For Plantation Division Question B, the CFO's approach does not achieve faithful representation under the IASB conceptual framework. For Part A, completeness is compromised because the valuation ignores uncertainty and risk. Neutrality is affected because the high valuation may overstate assets and profit. Free from error is also compromised because mature FFB prices are used for immature FFB without adjustment. For Part B, the CFO treats immature FFB as if they are ready for sale. However, these FFB are still growing, cannot be harvested, and their future benefits are uncertain. Finally, for Part C, the biological assets should be measured at fair value less cost to sell, or LVS-CTS, under MFRS 141, while considering the growth stage and related risks, so that the valuation reflects the actual condition of the immature FFB.
Moving on to question C, we look at the ethical dilemma facing the junior accountant. First, the risk. Complying breaches integrity since the figures are knowingly misleading. It threatened objectively due to pressure from the CFO, and it breaches due care by misapplying MFRS 141. Plus, it exposed the accountant personally if discovered later. The second, the steps. Before raising a concern, the accountant should verify the technical issues, document everything, and first discuss it directly with the CFOs. If unresolved, escalate to the audit committee or board, seek guidance from the professional body, and as the last resort, consider resignation or whistleblowing, keeping a records throughout. And finally, obligation to external users. Accountants owe a duty beyond their employer to investor, creditor, and the public who rely on this statement. Professional ethics must come before loyalty to individually. Thank you.
The correct accounting treatment for these three property assets. Property 1 must be split. The 7 lease floors are MFRS 140 investment property, while 3 corporate HQ floors are owner-occupied under MFRS 116 PPE. Property 2, the undesignated land floor is classified as MFRS 140 for capital acquisition. The third floor is acceptably MFRS 102 inventory as the unit are built for regular sale. The initial measurement for 3 properties measured at the cost. For subsequent measurement of property 2 and leased properties can be used fair value model. The HQ floors MFRS 116 must be used cost or revaluation model. For property 3, inventory must be measured at the lower cost and the net realizable value. Ultimately, the FOS proposal violates the faithful representation under the conceptual framework. By trying to inflating earnings ahead of investors' negotiation, the financial reporting loses its neutrality and fails to reflect the true economic substance how these assets operate. We must stick to the compliance standard. Thank you.
For Part A1, fresh states should recognize a provision for the product recall cost under MFRS 137. This is because the contamination occurred before year end. The company has announced the recall and it is probable that cost will be incurred. Since the cost can be reliably estimated, a provision of 1 million, which is the most likely amount, should be recognized. For Part A2, the company should not recognize a provision for the consumer lawsuit. Although a lawsuit has been filed, the legal advice estimate only a 30% chance of losing the case. As the outflow of resources is not probable, the lawsuit should be disclosed as contingent liability rather than recognized as provision. Under MFRS 137, uncertainty affects whether an obligation is recognized or only disclosed. If an outflow of resources is probable and can be estimated reliable, a provision is recognized, such as the 1 million product recall cost. However, if the outflow is only possible, such as the lawsuit with a 30% chance of loss, it is disclosed as contingent liability instead. Thank you.